Yeah. How are you all? Hopefully you're all nice and warm at home. I'm down in the South Island, so it's a bit cold and blustery down here and wet. Yeah, I'm so happy you can join me this evening. We're going to make a start and we're going to go through and have a good chat tonight about the mortgages and the OCR. I'm sure everyone's been listening out to find out what's going on, but we're going to make a start and have a chat about how the OCR is going to affect our mortgages. So we'll make a start here. Right, I need to make sure I get my screen going. Please excuse me for a second. Right, okay. So um, I love talking about the OCR. I've worked in banking for a really long time, and interest rates and mortgages and trying to work out what they're doing over time is really exciting. Today's OCR, or official cash rate, if you weren't sure what that means, announcement has definitely been hitting the headlines this evening. And lots of articles by lots of different economists have come out, and there's lots of economists that are now revising their pre-OCR predictions. The one thing I've learned after spending years and years in banking and finance is that we've listened to lots and lots of these OCR announcements. They are very important, but they're not most important thing. The most important thing is making sure that we've got some good structure in place to help us through these changes. So the OCR is important, but it is part of the puzzle that we have. So over time, interest rates will go up and down. That is a cycle. We'll see them rise, we'll see them fall, we see them sitting sort of stagnant for a little while, but it's really hard to predict what they're actually going to do at any particular time. So if you listen to the economists before OCR, they were 50-50 about whether it was going to rise or whether it was going to stay where they were. So, it's always hard for them to say what's going to happen. But at the end of the day, the markets have actually factored into a lot of the changes already. So what really matters is actually having the right lending or investment structure in place to help you when these things come through. So a well-structured mortgage with a really clear plan of how you repay your mortgage, building in what your surpluses and your retirement goals are, is actually one of the most important financial strategies that you can have. So the OCR is going to set some direction, but your financial strategy determines what your trajectory is. So we're going to make a start. How does the OCR affect our mortgage? So who am I? My name is Karen Beckham. I'm a financial advisor here at Enable Me. My background is that I worked in banks for over 30 years. I was a bank manager for over 20 years, probably more than 25, and at Westpac and ASB. My last role at ASB, I led a team of relationship managers looking after high value, high income earning clients, which was really interesting. My things I enjoy doing best in finance is things like investing and lending. So my job at Enable Me is to help clients to get ahead. After years of getting people into mortgages, I'm now helping people getting out of them faster. So today's presentation is for information only. The content isn't intended to substitute regulated financial advice. Come and have a chat to us is what I would suggest you do. And I'm not an economist. So what we will cover tonight is I'm going to try to explain what the OCR announcement means today, how the OCR impacts on mortgage interest rates, how to get your financial foundations working harder for you, and what to focus on to pay down your mortgage faster in any economic environment. So we're going to do a little bit of a poll. We're going to find out a little bit about how do you feel about today's OCR announcement. Are you optimistic about it? Are you cautiously watching what happens? Are you unsure what it means for you? Are you concerned about the impact, or you haven't maybe been following it, or you don't know what it's going to be yet? So if everyone would like to just vote, that would be fantastic, and I'll get an idea of how you're all feeling about it. Right, we've got our results in. So we had 9% that are optimistic about it. Okay, fair enough. We've got 35% of our audience are curiously watching what happens. 26% is unsure about what it's going to mean for you, so hopefully I'll be able to help you there. 13% are concerned about the impact. We've got 17% that haven't been following what's going on, so if you don't know, they did put it up. And then we've got 9% who aren't sure, they don't know what it means to them. So we'll make a bit of a start now. So, right. What does financial security, what is it and what does it give us? Well, financial security is something that most of us want to have. You know, you have it during some periods of your life and other periods things go a little bit skew with and we don't have it. So financial security for most people is peace of mind. It gives them options and that means that we have security. It means that we've got the ability to stop work if we need to. We've got the ability to follow our passions and do something slightly different. And we've got some stability through those volatile times. And very importantly, it gives us independence. It gives us the ability to do what we want to do. So the official cash rate, or OCR, as you've probably heard it called on many occasions, was actually raised today by 25 basis points. So it's gone up to 2.5%. So we've got to remember the OCR is just signalling what the outcome might be. It doesn't actually determine what it is. Already some banks have actually preempted the announcement and some of them have actually moved their rates earlier on. So last week you would have seen some of the banks have increased their shorter term mortgage rates, but they actually dropped some of the longer term rates, and that's because they've got an idea of what they think what is going to happen. So the OCR is signalling what they think what is going to happen, but a lot of what happens behind the scenes is actually the wholesale mortgage swap rates, and that's where the banks actually get their money from. So the OCR is really giving you a signal about what they think is going to happen in the future and what things need to be done to keep inflation under control. So it is a lever that they have that they can use to slow down inflation when we need it to. So as I say, the banks have preempted some of these rates, so we might not see a huge change tomorrow. We might do, but some of the banks have already made some changes. But there are other things that actually impact the interest rates. So things like the global markets, as I said, the wholesale funding costs, the bank's profitabilities, customer borrowing levels, and inflation. So at the moment, we're seeing that there's not a lot of people borrowing a lot of money at the moment. The banks are very, very competitive at the moment. So it'd be really interesting to see if any of the banks do put rates up, because they're obviously wanting to keep the clients they've got and attract new clients. So there are plenty of things that we have no control over, and the OCR and interest rates is one of those things. We have no control over inflation. We do our bit. We have no control really over what the election result is going to be in government settings. Obviously, we all want everyone to go out and vote. There's a lot of geopolitical tensions at the moment. We've got no control over that. We saw that with the start of the Iran war, unemployment rates and the cost of living. We can't do much about them, but we control what we can control. So when we look at that, if you think about your KiwiSaver since the war started in Iran, it has been like a roller coaster. I've noticed this week my KiwiSaver has gone up quite a bit, but there were times where it really dipped. So we've got no control over it. So we just need to have a plan. We need to know that our plan is what we need to do. We need to have confidence, and we need to have the right people supporting us, giving us confidence. So how do we deal with uncertainty? A financial plan really helps you prepare for potential changes and anything that's not anticipated. So that volatility that happens that we don't prepare for or don't think is going to happen. So a good plan helps you stay the course, and when things get difficult, it encourages your progress and those opportunities present themselves. So things will always change. There's always going to be things that happen in your lives that you don't expect, but having a good plan helps you prepare for those unforeseen things. So what we need to do is we need to focus on the things that we can control. So we need to cut through a lot of the noise. So to me, today when the OCR announcement came out, I kind of had a really rough idea that it was going to do either one or two things. It was either going to stay the same or they would raise it slightly. So what we need to do is we just need to focus on the things that we control, what our actions are. So we need to determine where we are today, We need to find out what our problem is we're trying to solve. We need to understand how long we've got it. So sometimes for us with mortgages or people with mortgages, it's like how long have we got until we have to get those mortgages repaid. We need to harness the behavioural tendencies, get those under control so we are actually doing the right thing with our money. And in some cases, we need to leverage our equity. So when we talk about our money tendencies, this is really important to actually have a think about. So I want you to think about this. When we talk about our money personalities, there are three main personalities. So have a think as I'm talking to you about which one you think you are. The first one we have is our savers. So our savers love having money sitting in their bank accounts. They feel comfort and secure having that money sitting there, and they often have a goal about how much they want to have sitting in their savings account. They can sometimes get a bit anxious when they spend money, and sometimes they can be a bit inefficient because they've got money in savings. And sometimes they feel that they live a bit of a frugal life. On our flip side of the savers, we have our shoppers. Our shoppers get energized by spending money. Now, in the past, I was a shopper. My debit card actually had AKA shopaholic on it for a while. I've totally changed my money personality because you can do it. But shoppers enjoy going out and buying things. So they can often just buy things on the spur of the moment. They might see something and think, well, that's quite nice, I'll have that. So they get energized by spending money. And they're quite often quite generous people. So they need to have guardrails in place to stop them from overspending. So good plans and structures in place. And between the saver and the shopper, we've got a personality type we call a plodder. It's not a bad term. It's actually quite a good term. Plodders can save when they want to and they can spend when they want to, but sometimes they are a bit inefficient with the way they do things. So that's an interesting point. Think about what money personality you are because it helps you understand why you do what you do with your money. Then we think about our cash position. So, this can change from time to time also, but we have our positions for that. When we think about it, this is a mindset, is how do you feel that your financial position is? So sinking is where you feel like you're going backwards. Floating is when you're doing okay, but you're just not getting ahead that quickly. And flying is where you have got all the money coming in. You don't need to worry about it, but you just might not have a plan about what you're doing with your money. So those are our cash positions of where we feel that we're sitting, and hopefully we're all sitting in the floating or flying. If we're sinking, then we need to start doing something a little differently, but those are the different positions that we've got, as in your cash flow position, how you feel about your money. Then we've got our approach or tolerance to risk, and that can actually stop you getting ahead, or it could be you might have a approach that you're a bit of an adventurer and you're just going to just jump in, boots and all, or you might be a dreamer where you like to do something but you never quite get to it. You're a bit of a procrastinator, or a safety wardens where they just don't want to do anything because they're just too afraid to go ahead and do anything. So understanding your money tendencies and your personality is really important because it helps you understand why you do what you do with money. So there are three things that you can focus on in any economic environment. The first one is maximizing your savings. And some people go, but I can't save. Well, I'm sure you possibly can if you get a good plan in place. Once you've worked out what your savings could be, you need to then start working on your mortgage. So we want to get rid of that mortgage as quickly as possible. Once you've got that mortgage down, we want to unlock some equity to build wealth. Right. So maximizing your savings, how do you increase what's left over? Now, a lot of people are going to say, I can't save. I find it really difficult. I'm living paycheck to paycheck. We hear that quite often. So this section just talks to you about how you can actually do it. So to start off with, we need to work to a plan. We need to benchmark and track our spending. So often people don't have a budget or a spending plan. So it's important you put one in place and you track your spending against what you think that you're spending. We need to establish some systems to make sure that you're not overspending and that we automate as much of your bills as you possibly can and have access to the money that you can spend, and try to keep money aside to spend for the longer term goals. We need to work out what are the things that you consider your non-negotiables, the things that kind of give you joy in life that you don't want to give up, because we don't want a spending plan that is so rigid that you feel like you've had all the joy in life sucked out of you. So we want a nice, enjoyable life, but we want to know what are the things that we don't want to give up, and then how can we actually eliminate that fritter. So fritter is when you start to spend money on things that really aren't that important in your life and you don't even realize where it's gone to. And that's how, when we track your spending, we start to understand where your fritter is coming from. And then from there, we also want to maximize your income. So there's a lot of different ways we can do that. We sometimes think that what we earn is what we earn, but there's different ways of looking at it. Could be KiwiSaver, could be other things that are coming out of your income. So I want to give you an example of some people who I've been working with recently. They're a really young couple, got two young kids. When I first met them, they said to me, we've not been able to save anything. Since we had the kids and the mortgage, we can't save anything, and we're quite concerned about our money. We're sort of living paycheck to paycheck, and sometimes we just worry about the bills coming through. So when we sat down and had a chat during our financial consultation, we sat down and we did a spending plan for them, and actually it came up that they should be able to save about $20,000 a year. Now, they were absolutely blown away that they could do this. Now, if they could save that $20,000, that's their surplus, it meant it would change their mortgage from a 22-year mortgage-free time frame to a trajectory of only 8 years. So they were really motivated to do that. So with all the tracking of their spending, setting up the right structures, being accountable, meeting up with a financial coach, after 7 months, they've actually saved $9,500. Now they're blown away because they never thought they could do that. During that time, they've had a holiday overseas and things like that. So it is doable. It's just a matter of having a good plan and having the right support with you. Right, so maximizing your fritter, or minimizing, I should say. So most Kiwis actually fritter about 15% of their household income, and it's done on things like discretionary spending. So takeaways can often be one of those things. You had a tough day at work, you come home, can't be bothered cooking, you order Uber Eats. Everyone's been there and done that. It's the extra trips to the supermarket. Now, I see this a lot when I'm dealing with clients, is that when we're going through their money for it tracking, we're like, how many times a day do you go to the supermarket? We have some people that go every day to the supermarket. I'm sure that they must have a part-time job there, but those extra spends every time you go into the supermarket really add up, because you never go in and get one thing, you walk out with 3 or 4 or a basket load. So we want to reduce those things. Looking at those fixed costs, subscriptions are really, really things that suck money out of your budget. So if you've got Neon, Netflix, Disney, Amazon Prime, Google, YouTube, it all adds up. I had a client today, they were spending over $200 a month in subscriptions. It's like, whoa, maybe we could just cut some of those back a bit. And really importantly is your mortgage structure. So making sure that your mortgage is structured correctly is very important. Looking at your utilities, review your utilities on a regular basis, your power once a year, look at where your mobile phone is with, or your internet bills, and look at your bank fees. Shouldn't be charged too much in bank fees, but if you've got the wrong account, you may be getting charged fees on that. So there can be some of the little things that add up. So we've got another poll. So we want to know, are you mortgage free? So the answers are yes, or I don't own my own home, or no, I've got more than 15 years to go, or no, I've got less than 15 years to go, or I'm mortgage free on my home, but I'm not on my investment properties. So if we want to answer that little poll, it'll give us an idea of where everyone's sitting at the moment. Okay, interesting. Okay, so we have 5% of our audience has no mortgage. They're mortgage free. Well done. Congratulations. That's awesome. We have 3% that don't own their own home yet. We have 46% of people that have got a mortgage and they've got more than 15 years left to pay off their mortgage. And then we've got 41% that have got a mortgage with less than 15 years to go. And then we've got 5% who are mortgage free on their own home, but they're not on their investment properties. So that's really quite an interesting spread. So there's quite a few people sitting in the audience that have got mortgages with a decent length of time that they've got to pay those off. So you need to come and see us. Right, what we're going to talk about next. Right, we're going to talk about how do we crush our mortgage. So, to get mortgage free well before you hit retirement is very important because you do not want that as an ongoing cost. Mortgages, if you're paying $2,000 a month in your mortgage payment now and it's over 30 years, you'll be paying $2,000 a month in 30 years' time unless interest rates change. So, or you can make some major changes. So, really important to get mortgage free. There's already going to be enough cost during retirement that we're not going to be able to do much about rates and insurances and things like that as some of those things. So, we need to get mortgage free before we retire. So, the faster you pay off your mortgage, the less interest that you're going to end up paying, and that frees up cash to invest elsewhere. It also gives you the opportunity to unleash the leverage in your home, and you can look at buying an investment property. So those are the important reasons why we want to crush the mortgage as quickly as possible. So the difference early repayment can make. So if we look at an average first home mortgage of $550,000 on a mortgage rate of 5.49%, if we look at how much you pay the banks, it's quite startling how much you pay them. So over a 30-year mortgage term, which is pretty standard for a first home buyer to get a 30-year mortgage term, you're going to pay about $572,000 in interest. If we can get your mortgage through in 15 years, that drops down to $257,473, which is a great savings. But if we can get you down to 10 years, it means you're only paying the banks about $165,000. So potentially you could save yourself about $407,000. That's a huge amount of interest that you don't pay the banks. And the banks do make some massive, big profits in New Zealand. One thing that really gets me mad when I see new clients is that they've been to their bank or they've been to a mortgage broker and they've got one big loan. So they don't have their mortgage split into little bits and that. They have a mortgage of $550,000. It's on a 30-year mortgage term, and that's what they've been given. So that is so, so bad because the risk of interest rate shock, like we saw after the COVID bubble, is a real risk, and it can be very, very damaging to your finances if you get out of a fixed rate and the rates have gone up. So if any of you out there have got a mortgage structure where you've just got one loan or one very, very big loan, maybe a smaller one, you need to look at the structure and the strategy behind your mortgages. So it's really, really important that we get the structure right. We work with what your surplus is and we actually structure your mortgage so that you're paying it off faster. And it doesn't have to be difficult. It can be very simple, but we need to help you do that. And as we say, it can save you hundreds of thousands of dollars. So when I used to work in banks, a lot of people would say, my goal is to get mortgage free. And that's absolutely true. Most people say, I just want to get mortgage free. But that isn't where the journey ends. That is like the beginning of the next phase of your financial life. So being mortgage free isn't an end game. You get there and you're like, oh, what do we do next? So we want to have a plan. What do we need to do next? So we need to start focusing on unlocking all the pathways and opportunities you've then got available to you to grow wealth. Okay, so we want to unlock our equity and we want to build wealth. So that's an important strategy to get you towards retirement, because being mortgage free in your own home is fantastic. Your home isn't really an investable asset, so it's not going to produce any income unless you've got borders or anything like that. So we need to have other assets outside of our home that are going to start to create wealth and be able to give you an income during retirement as well as your KiwiSaver. So the effects of paying off your mortgage earlier means that it gives you a slightly longer runway to actually start to save. So if you pay off your mortgage at 65, you've basically got your KiwiSaver, any small savings that you may have, and your money is going to last you probably a short period of time. But if you can get mortgage free earlier, say at the age of 55, then you've got the extra 10 years to save and grow your wealth for your retirement. And that means that extra 10 years gives you all of that wealth creation time to actually enable you to spend more money for a longer period of time. So what we want to do is we want to sort of get you mortgage free as quickly as we can so that you can start to grow your wealth for retirement. And at the moment, we've heard a lot in the media about the age of retirement going up. Maybe there's going to be changes to national superannuation. My thoughts on it is that you need to be able to look after yourself, because if something does change, you're not going to be able to go back out to work and save more money. So you need to be able to do this yourself. You need to take control of your finances and get you where you need to be. So there's still about 59% of Kiwi mortgages holders that are experiencing mortgage stress. So we want to take that stress away, give you a lovely structure, give you a nice spending plan, lots of accountability, and put some structures in place to help you get mortgage free faster. And that's actually as simple as it is. So, next poll, we seem to be doing lots of polls tonight. What do you currently invest in? Is it just KiwiSaver? Do you have an investment property? Do you have some shares or sharesies? A managed fund? Term deposits? Interest? I won't say high interest savings because I don't think there really is much of that at the moment. Or we just don't have any investments. So, where do we sit at the moment with our current investments? Right, and the results are in. 97 people here are invested in KiwiSaver. Fantastic. That's awesome. KiwiSaver is a really important vehicle for us to save for our retirement. And with the changes that are coming through to KiwiSaver, hopefully that's going to mean that we save more for our own retirement. We've got 29% of people who actually have investment properties. That's awesome. We've got 49% of people who've got money invested in shares or maybe sharesies. 11% are in managed funds. 17% are in term deposits, 29% are in high interest savings. Now, I'm going to challenge you on high interest savings. At the moment in New Zealand, they're not particularly high. So, if you've got a mortgage and you've got savings or term investments, we need to have a bit of a chat about that. And then we've got 3% that don't have investments. That's fine. Hopefully, you've got KiwiSaver. Okay, right. Next. I'm going to give you a bit of a scenario. I talked to you about my other clients who I've seen just recently, but these are clients of Enable Me. They're, I think, Alicia's clients. So Catherine and John came to Enable Me back in 2019. They were in their early 50s. They had a big mortgage to pay off, but they wanted to retire at 65, but they weren't sure that they were going to be able to. So fast forward to 2026, they now have a mortgage-free home. They've got an investment property. They've got KiwiSaver building wealth in the background. Their retirement projections show that their money should last until the age of 93. So that's a great outcome. And they've also got emergency buffers for around about a year of ongoing money saved up. So that's an awesome picture. That is a great way of showing the difference you can make if you get a good plan in place and having the right people to work with. So during that period of time, we had their mortgage time frame was originally 18 years. We thought they'd get it paid off within 7, which was fantastic. It would have been a great outcome. But by 2026, they'd actually paid off their mortgage within 6 years. So they got really, really involved in the program and they got really behind it and it became part of their financial DNA. They did things that they were meant to be doing and it just became automatic. They've ended up saving about $61,000 in interest by paying off their mortgage faster. And they've actually saved an emergency buffer. So they've got about a year's worth of outgoings. So if anything happens, they've got the money there. So their net worth has increased by about 67% over those 6 years. That's with house value increases, investment increases, and with their mortgage repayments done and dusted. So when we look at savings, or investing, we kind of think, well, what's the right option for you? And it all depends on what your time frame is and what you're trying to solve. So there's a lot of different investment options out there. There's shares, bonds, managed funds. Quite a few people have precious metals. I don't think it counts the jewelry that we wear, but gold and silver. People have collectibles, digital currencies, ETFs, index funds, forestry, term deposits, property, businesses. So there's a lot of different things we can invest in. So there's there's a huge selection of what you want to invest in, but it depends what makes you feel comfortable and what you're actually happy to invest in. When we sit down with our clients at Enable Me, what we do is we work through what your income is, we work out your outgoings, so we understand what your cost of your life is costing you, and then we kind of work out how much money you need for retirement. There is no magic number. So if somebody tells you you need $1 or $2 million, They don't know because they don't know how much your life is actually costing you. But we believe that if you've got a retirement shortfall, which is more than $300,000, you're probably going to need to leverage against your property to buy an investment property so that you can actually grow some extra wealth to fill that gap, that $300,000. So when we talk about leveraging, sometimes people are not sure what that really means. So I'm going to give you an example of two options. So say you've got $160,000 and you're thinking, well, what do I do with it? Well, you could put it into a managed fund and a growth fund, and that might return you about 5% after tax and fees. If you have 160,000 with that 5% return, it means that you're going to get about $8,000 a year. If instead you can use the $160,000 or leveraging against your property, and the growth rate of property goes up by about 5%, you're actually buying an asset that's worth a lot more money than you've actually got to invest. So you're using your deposit or you're using your house as security, but you're buying an asset of say up to 800,000. So if that $800,000 property goes up by 5%, your net return is about $37,000. Okay, so that's the difference is because you're starting with 160,000 and that growth is on the 160,000. But if you're able to buy an asset that's got a larger value using the bank's money to help you buy it, then your asset will go up in a higher amount because it's a higher valued asset. Hopefully that makes sense. Right. Um, just one of my favorite sayings, and I think this is really, really important when we've got things like OCR changes and interest rate changes. Incredible changes happen when in your life when you take control of what you have power over instead of craving control over what you don't have. So I think it's really important. We just need to focus on what we can control. So what is the best approach for you? Well, it depends on a lot of different things. It depends on your time frame. It depends on your goals. It depends on your risk appetite, your capacity for risk, so whether or not you can actually do the things you want to do. It depends on your cash flow requirements, so how much money do you actually need. It also is on the ability of whether or not you can actually borrow money from the banks because we can't always borrow what we want when we want it. It's whether or not you can access your equity and what your wealth goals are. So with an investment plan, time in the market is so much better than trying to time the market. So what happens next? I'm going to suggest that you come and see us to have a financial consultation. So our financial consultations are a 90-minute strategy session, and you'll be sitting down with either myself or one of my colleagues. We're all financial advisors. And what we do is we sit down and we try to get the full picture of your finances. We look at your assets, your income, your spending, your debt, your mindset, and your goals. We try to identify those inefficiencies, the wasteful spending, the bank fees, your mortgage structures. We look for ways that we can actually help you. And then we try to work out what your trajectory is. So we sort of work out where you're going to be if you carry on doing what you're doing and what you could achieve if you have the right financial plan in place. So the sessions are 90 minutes. I'll have a slide next which will actually give you a voucher that you can actually get a slightly discounted rate. But the sessions are really informative, and for most of our clients that come and sit with us for 90 minutes, they do get a lot out of the sessions. It is high level, but we aim to try to help you as much as you can. So if you are interested in coming and seeing myself or one of my colleagues, please do scan the QR code. If you book your financial consultation this evening, you'll get the financial consultation for $100. If you book after this evening, the consultation cost is $149. Next, we've got question and answer time. So, Amy, do we have some questions that I can answer there?
Yes, we do. So thank you so much, Karen, and also to everyone who joined us this evening. So some of the questions that we've had submitted. First of all, is it a good idea to buy a first home or start a mortgage now if you're on a single income?
If you can afford to, absolutely. If you're on a single income, there's other things you can do. You can get flatmates in. So if you buy the right home, you can have a flatmate or two helping you with the mortgage. You do have to watch out that you might have to pay tax on it. But it is a good time. At the moment, it is a bit of a buyer's market out there. People aren't selling houses as quickly as they'd like to. So it's a good opportunity for first home buyers. The banks are actually really keen to lend money. So I think it's a great time if you can afford it. Work the numbers out, make sure that you're okay. I think it's a great time to buy. In fact, my daughter's just bought her first home. She moved in last week, so she's a first home buyer. It can be done.
Great, thank you, Karen. Now, also, are revolving credit mortgages still a good option? And do you need to still have an emergency fund if you have one?
Okay, two parts to this one. If you have a revolving credit facility, I wouldn't recommend having savings. The whole point of revolving credit facility is to try to save you interest. And I always use the example. So if you've got money invested at the moment, you'll be sitting around maybe 1.5% if you're sitting on something like a savings on call account. Whereas if you've got a mortgage, it might be 4.5%, 5%. So therefore, you're going to earn 1.5% less tax and you're paying the bank 4.5%, 5%. So it doesn't make sense to actually have money sitting in a savings account. So should be paying it off your revolving credit. Should you have a revolving credit and is it right to have one? Yes, it is, as long as you are disciplined with your money. So it's really important that you have a spending plan, that you track your spending and you don't overspend. A revolving credit facility is a great tool to help you be more interest efficient, but I would only suggest that you do it if you have a good control over your finances, your spending habits.
Great, thank you, Karen. I've just had a question pop up in our Q&A box. So how can we build wealth over 4 years? Hubby is now 61 and I'm at 51.
Good age, good ages towards saving and growing wealth. It really depends when you're going to need the money. Like a lot of people think that when they turn 65, they've got to have all the money sitting there ready to go. You don't. So if you're 61, it doesn't mean that you can't grow wealth. If you were to buy an investment property, we tend to say hold on to it for 10 to 12 years. So that means that if we get some growth coming through, which we should start to see, I know a lot of people with their house prices haven't seen it in the last few years, but traditionally we get that growth. When the properties go up in value, then in 10 to 12 years, you should see quite a nice increase. And that's when you can actually cash that property in and you can sell it. You can then have that money that you've gained in capital, and that just refills the bucket of money that you need for the rest of your life. So having a 51-year-old partner is fantastic. The banks still lend you money when it's an investment property because they know that the investment property will continue to earn an income via the rent it comes in.
Thank
Hopefully
you,
that makes sense.
Karen. Yes, absolutely. Another question, is it better to invest in any excess funds rather than paying down on your mortgage?
Like I always say, pay down your mortgage. Don't invest it elsewhere. Your mortgage is one of those things that will stay there for a really, really long time unless you take some action. So try not to invest elsewhere. Really concentrate on getting your mortgage paid off. In fact, I always say to people, if you've got KiwiSaver, if your employer puts in 3.5%, put in 3.5%. While you've got a mortgage, don't increase your KiwiSaver payments unless your employer matches a higher amount, because we really want to get you mortgage free as quickly as possible. The faster you can get mortgage free, as we showed you on one of the other slides, means that you've got those years later that you can grow your wealth, but it means that you're not going into retirement with a mortgage debt, because that is quite crippling when you've got insurances and rates and things like that to add on to all of that.
Thank you, Karen. Now, we're trying to decide whether we should go interest only on our rental and pay off our own home loan. Any tips on making this decision?
Easy. Pay off your own home loan. Please, please, please do that. At the moment, we've got tax deductibility on investment properties, so hopefully you're taking advantage of that. But you don't have tax deductibility on your own home, so get rid of your home mortgage quickly. That gives you the options to do other things. While we've got tax deductibility on our rental properties, they sort of take care of themselves. So Yeah, your own home, you've got to get mortgage free on that first. That should always be your priority. So if you can go interest only on an investment property at this point in time, that is the right thing to do. Some banks are actually giving 10 years interest only straight off, so you don't have to keep going back and reapplying for it. But I would always get mortgage free on my own home before I started paying down my mortgage on my rental property.
Thank you. Now, a second part to that question that's just come through. Do we then hurry to pay off rentals once we're mortgage free?
Depends. Like you can do, or you could buy another rental property, or you could start investing elsewhere. Because we want you to have a diversified investment portfolio. So an investment property is one part, but you could start looking at investing in other things like a managed fund or shares or whatever it might be. So it's good to have a bit of cash diversity as well. If you pay everything off your mortgage and then you need some money, it's really hard to go to your tenant. Actually, I'm going to put the rent up because I need a bit more money. So I think you do need to have something a bit more of a liquid asset. So I think diversification is really important. So I wouldn't be paying off my rental mortgage. I'd probably be starting to save a bit of a buffer elsewhere. So I've got diversity.
Thank you, Karen. So, one time for one last question here. Any recommendations on figuring out whether refinancing is a good option right now?
Oh my goodness, I have seen some really good rates coming through just recently. Even though we had the OCR announcement, the banks are actually offering some pretty good rates. So it is a good time. There's not a lot of people doing things in the market at the moment. You know, people aren't really buying and selling at great pace at the moment due to the election probably coming up as well. So the banks are all wanting to get your lending. So they're paying out some nice cash contributions and interest rates are looking pretty good. So it is pretty competitive out there. So, yep, absolutely. If you're not still within the cash retention period of the last time you got given a payment, um, absolutely look at shopping around a little bit. And if you don't want to go and shop around for a new bank, ask your current bank if you're happy with them. Ask them if they'll give you a cash retention payment if they haven't given you one. They don't offer them freely. But if you're with your bank and you've been there for a while and you're pretty loyal and you had the option to move, but you decide you don't want to, you could just go to them and just say, will you pay me some money to stay with you with my mortgage? And they may give you a few $1,000s, depending on how big your mortgage is. But yeah, they're very competitive at the moment.
That's fantastic. Thank you. I'm actually going to squeeze one more question in that's come through the chat, just some clarification. They weren't really sure on the previous question. Is it recommended not to have your emergency fund in a normal savings account?
If you've got a revolving credit facility, so if you've got a revolving credit facility, I wouldn't have savings because it just isn't interest efficient. So I'll see if I can explain it better. So if I had $100,000 sitting in savings, earning 1.5%, I'm going to get $1,500 in interest for a year, less tax. If I have a mortgage and I was to pay that $100,000 off, if my interest rate's 4.5%, I'm going to save $4,500. So it's actually better to pay that off your mortgage. So having a revolving credit facility means that you've got the ability to draw it back. So it's just a way of parking your money and being more interest efficient. So hopefully
Thank
that makes
you.
better sense.
I definitely know which one I'd prefer to do.
I know. And I spoke to some clients today and we went through exactly that scenario and they're savers and they love having their money sitting in their bank account. And then we said I actually worked the figures out. They had $190,000 sitting in savings. They had a $400,000 mortgage and I think it was about 4.75. And we worked it out. They would save $8,500 just by paying it off their mortgage, but giving them the ability to draw it back if they needed to. So yeah, it's one of those things. If you're a bit of a saver, you have that security and comfort in seeing money sitting in your bank account. So it can be a real hard mindset to actually pay it off a revolving credit facility, but it is worthwhile.
Oh, great. Thank you, Karen. Now, that is all the time that we have for questions. We do encourage you, if you've got any further questions, please scan that QR code. I've also put the link into the chat. You can book in or you can go to the contact us form, pop in your questions, and our lovely onboarding team will get back to you. But I'll hand back to you, Karen, to say goodnight.
Yeah. Yeah, I hope everyone's got something out of this evening. I really enjoy talking to people about how I can help them get ahead. So please do book in. I'd love to have a chat. And so with my colleagues, if you don't get a chance to see me, I'm based in Christchurch, but available on Teams if you want to have a chat. If not, we've got coaches throughout New Zealand. So please reach out and have a chat to us. It makes a massive difference if you've got a mortgage. Hundreds of thousands of dollars can be saved, and the investment of your time is priceless. So have a nice evening. Thank you very much.